Hey, welcome. In the next few minutes, we're going to pull back the curtain on the stock market. We're going to break it all down and give you the essential tools you need to get started on your own investing journey.
So, let's just jump right in with a pretty provocative question, but it's an important one. Why are savers losers? I know, it sounds a little harsh, right? But trust me, understanding the answer to this is really the key to building wealth. The one-word answer? Inflation. See, every single dollar you have tucked away in a savings account is actually, slowly but surely, losing its power. I mean, think about it. The cost of groceries, gas, everything goes up over time, so your cash just buys less and less. You're not just standing still by saving, you're actually falling behind.
Okay, so if just saving your money is a losing game, well, how do you win? This brings us to the most important part of building wealth. You've got to harness the power of growth, and you do that by investing.
In this number right here, this is why investing is so incredibly powerful. Historically, the stock market has returned, on average, around 10% per year. Now, of course, what happened in the past doesn't guarantee what's going to happen in the future, but it shows you the kind of potential your money has to not just keep up with inflation, but to grow way, way beyond it, thanks to the magic of compounding over time.
So we've covered the why you should invest your money. Now, let's get into the what. What in the world is a stock anyway?
It's actually pretty simple. A stock is just a small piece of ownership in a company. So when you buy a share of, let's say, Apple, you're not just playing with numbers on a screen. You are literally becoming a part owner of the entire business. You have a claim on their profits, their assets, the whole thing.
Here's a great way to think about it. If a giant company is like a whole pizza, buying one share is like owning a single slice of that pizza. And you know, the more shares you buy, the bigger your piece of that delicious pizza becomes.
So how do we figure out how much that whole pizza is worth? Well, that's something called market capitalization, or market cap for short. You start with the company, that's the whole pie, then that pie gets sliced up into millions, sometimes billions of little pieces called shares. Each one of those shares has a price. All you do is multiply that single share price by the total number of shares out there, and voila, that's the company's total value on the market. All right, you get what a stock is. Now you're facing your very first big decision as an investor. Are you going to bet big on one single slice of pizza, or would you rather own the whole variety box?
You basically got two main paths you can go down. You can buy an individual stock, which means you're putting your faith into just one company. It's definitely high risk, but it's also high reward. Or you could buy something called an ETF, an exchange-traded fund. Just think of an ETF as a big basket that holds little tiny pieces of lots of different companies all at once. This automatically spreads out your risk, so you get what's called diversification without having to do hundreds of hours of research on your own.
Okay, so you've picked a strategy. Now for the fun part. How do you actually go out and buy a stock? Well, first things first, you'll need to open an account with a brokerage firm. That's just a company that gives you access to the market. Once you do that and put some money in your account, you're all set to place your first order.
When you go to buy, you'll see two main choices. The first is a market order. That's basically the buy it now button. You're just telling your broker, hey, get me this stock right away at whatever the current price is. But then there's a limit order. That's more like a buy it if button. With this one, you get to set the maximum price you're willing to pay, and your order will only go through if the stock price drops to your target. So a market order is all about speed, and a limit order is all about price control.
Buying your first stock is a really huge step, but successful investing is all about your mindset. It's about understanding that relationship between risk and reward, and most importantly, it's about playing the long game.
Let's talk about risk for a second, because it's not just about the chance of losing money. Risk is the whole reason investors get paid in the first place. You're being compensated for taking on uncertainty, the chance that things might not go exactly as planned. And generally speaking, the more risk you're willing to take on, the higher your potential reward could be.
And speaking of playing the long game, here's a pretty cool incentive to be patient. It's not just a good strategy, it's something the government actually encourages you to do through the tax system.
So here's how that works. If you buy a stock and then you sell it for a profit in under 1 year, that's called a short-term capital gain. It gets taxed at the same rate as your regular income. But, and this is a big but, if you hold on to that same stock for more than a year, it becomes a long-term capital gain, and it gets taxed at a much, much lower rate. The message is pretty clear, right? The system is designed to reward long-term investors, not short-term traders.
So there you have it. We've gone through the whole journey, from why you need to invest in the first place, to what a stock is, how you buy one, and the patient mindset you need for success. You've got the fundamental playbook now,
So the only real question left is, what's your first step going to be?